Good day, future accountants. We are the Group 8, and today we will be discussing to you about cost of capital. So, at the end of the presentation, we shall be able to meet the following learning objectives. Now, proceeding to the topic, what is cost of capital? Cost of capital represents the return a company needs to achieve in order to justify the cost of capital project, such as purchasing new equipment or constructing a new building. Cost of capital revolves around the capital structure, which includes debt, preferred stock, and common equity that are utilized to finance the firm's assets and other resources. Why are cost of capital essential element in a firm's capital budgeting process? So, cost of capital is an essential element basically because it is a primary determinant of a firm's long-term stock price. Meaning, cost of capital focuses on the long-term financing aspects. Note that working capital is the short-term financing and cost of capital is the long-term financing.
Now, the sources of capital are the debt, preferred stock, and common equity. So what is debt? Debt. The main source of debt is from the creditors. Commonly is the long-term debt. No, not the short-term debt, because short-term debt only focuses on the working capital. And the long-term debt is the debt that matures in more than 1 year and is often treated differently from the short-term debt. Debt also consists of borrowed money that is due back to the lender, commonly with the interest expense and the notes payable. Second is the preferred stock. Is a class of stock that is granted certain rights that differ from common stock. Thus, preferred stock often possesses higher dividend payments and a higher claim to assets in the event of liquidation. Preferred shareholders have priority over common stockholders when it comes to dividends, which generally yield more than common stock and can be paid monthly or quarterly. And last is the common equity. In capital structure, equity consists of a company's common new preferred stock plus retained earnings. So what is retained earnings? Retained earnings are the amount of profit a company has left over after paying all its direct cost, indirect cost, income taxes, and its dividends to shareholders. Now, this is considered invested capital and it appears in the shareholders' equity section of the balance sheet.
Capital components is used by firms to raise funds. It is the investor-supplied items, namely debt, preferred stock, and common equity. So the first component cost that we will discuss is the component cost of debt. It is the rate a firm must pay on its new debt. There is a before tax and an after tax cost of debt. The before tax cost of debt is the interest on firm's new debt, and after tax cost of debt is the relevant cost of new debt taking into account the tax deductibility of interest. The formula for this is after tax cost of debt is equal to interest rate on new debt minus tax savings. So we provided a sample problem for you to practice the formula given. You will just have to follow the formula to get the correct amount. The discounted cash flow or DCF approach. This approach is used by companies that are expecting to remain in business indefinitely. The cash flows are the dividends. Shown above is the formula for this approach and the sample illustration to practice it.
Moving on to the second component, the component cost of preferred stock. Component cost of preferred stock is the rate of return investors require on the firm's preferred stock. Unlike bonds, preferred dividends are not tax deductible. Hence, the before and after costs of preferred are equal. So the cost of preferred stock is equal to preferred dividend divided by the price of preferred stock. Shown in the slide is a sample illustration for this component. And lastly, the third component, which is the component cost of retained earnings. Cost of retained earnings is the cost of internal equity. It is common equity raised by retained earnings. It is the rate of return by stockholders on a firm's common stock. There are three ways to determine the cost of common equity. Number 1, the CAPM approach. Number 2, the bond yield plus risk premium approach. And number 3, the DCF approach. Let us discuss first the CAPM approach. So, the capital asset pricing model approach is the most widely used method for estimating the cost of common equity. The formula of this method is risk-free rate plus open parentheses expected return of the market minus risk-free rate close parentheses multiplied by beta coefficient. Shown in the slide is a sample illustration for this method.
So now we will discuss the weighted average cost of capital. its formula and set some examples. So the weighted average cost of capital represents a firm's average cost of capital from all sources, including the common stock, preferred stock, bonds, and other forms of debt. So the weighted average cost of a capital is a common way to determine the required rate of return because it expresses in a single number the return that both bondholders and shareholders demand in order to provide the company with capital. So a firm's WACC is likely to be higher if its stock is relatively volatile or if its debt is seen as risky because investors will of course demand a greater returns. WACC is also important when analyzing the potential benefits of taking on projects or acquiring another businesses. So if the company believes that a merger, for instance, will generate a return higher than its cost of capital, then it's likely to be a good choice for the company. However, if its management anticipate a return lower than what their own investors are expecting, they will put their capital to better use. Anyway, always remember that a good WACC usually lower WACC. A high WACC is generally a signal of higher risk. All else equal, the lower the WACC, the higher the market value of the company.
To get the weighted average cost of capital, we need to learn the formula and its capital and cost components. Simple KD is the rate at which the firm can issue new debt. This is the yield to maturity on existing debt. This is also called for the before-tax component cost of debt. Symbol KD times 1 plus T is the after-tax cost of debt. Here, the T is the firm's marginal tax rate. The after-tax component cost of debt, KD times 1 plus T, is used to calculate the WACC. Symbol KPS is the cost of preferred stock. And lastly, the symbol KCE is the cost of common equity. It is the required rate of return on common stock and is generally difficult to estimate. Now, we proceed with the WACC formula. The average cost of capital is given by weighted average cost of capital is equal to WD times KD times 1 minus T plus WPS times KPS plus WCE times KCE, where WD is the percentage of debt in the capital structure. WPD is the percentage of preferred stock in the capital structure. And lastly, the symbol WCE is the percentage of common stock in the capital structure. Now, let's proceed with the example.
Suppose Dexter's Incorporated's target capital structure is as follows. Percentage of debt in the capital structure is equals to 0.45. Percentage of preferred stock in the capital structure is equals to 0.05. And percentage of common stock is equals to 0.50. Its before tax cost of debt is 8%. Its cost of equity is 12%. Its cost of preferred stock is 8.4%. And its marginal tax rate is 40%. Dexter's weighted average cost of capital will be the sum of the product 0.45 times 0.08 times 0.06 plus the product of 0.085 times 0.084 plus the product of 0.50 times 0.12 equals to 0.0858 or 8.6%.
So I will discuss how taxes affect the cost of capital from different sources. So the effect of taxes on debt. In most jurisdictions, interest on debt financing is a deduction made before arriving at a taxable income of a company. We may recall that in the equation to compute the weighted average cost of capital of a company, the expected before tax cost in new debt financing is adjusted by a factor 1 minus tax rate. The effect of taxes on common equity and preferred stock. Taxes do not affect the cost of common equity or the cost of the preferred stocks. This is the case because the payments to the owners of the sources of capital, whether in the form of dividend payments or return on capital, are not tax deductible for a company.
So that's it. I hope you enjoyed and learned about the cost of capital and its components. So, goodbye. Thank you for watching.